Good afternoon, and welcome to the DC Bar Pro Bono Center's webinar, You and Your Business, Why Keeping Them Separate Matters. I'm Christine Kulumani, staff attorney with the DC Bar Pro Bono Center's nonprofit and small business legal assistance programs. Thank you to my colleague, Lauren Paley, who has done all of the behind the scenes work to make this webinar today possible. Also, a tremendous thank you to our presenters, Jennifer Kent, a senior associate at the law firm Latham Watkins, and Brad Guest, an associate at the same firm. Brad and Jen are also both superstar volunteers at the Pro Bono Center's small business brief advice legal clinics, and they have a tremendous feel for the legal needs and questions common to small business owners, such as those of you listening live or the recording. Before we get started, I just want to go over some of the logistics for today's webinar. For those of you joining us live, this webinar will be recorded. To access the recording, please complete the post-webinar survey that will be emailed to you. Additionally, you have immediate access to the presentation slides in your GoToWebinar control panel under Handouts. If you have questions as we go, please send them through the questions box. At the end of the presentation, we'll get to as many as we can during the time we have allotted, as well as some of the questions that you sent ahead of time. And now with that, we're done with the mechanics of today's webinar and a reminder of why we're here. As businesses start up initially or grow, many owners decide to form an entity for their business, a separate legal person in the eyes of the law, in an effort to make sure that they're not personally responsible for business liabilities. It's critical to know if your chosen entity affords you the protection you thought it did, what steps you can take to ensure that you're keeping yourself distinct from the business entity, and perhaps most importantly, know what actions or inactions may put you or your business at risk of being treated as one. And with that, I handed it over to Jennifer and Brad. Thank you both again.
Great, thank you, Christine. So for everyone on the presentation, again, my name is Jennifer Kent. I am a senior associate in the Washington, D.C. office of Latham Watkins, which is a law firm here in town. As Christine mentioned, I have been volunteering with the DC Bar Pro Bono Center's small business and nonprofit clinics and workshops for about four and a half years now. And it's absolutely been one of the highlights of my career. I love hearing about all of the incredible business ideas that members of our community here in DC have. So really excited to be talking to you today. For those of you I might have met at a small business clinic over the years, hello again. And for those who I haven't met yet, thank you so much for tuning in.
My name is Brad Guest. I'm also associate at Latham Watkins. My practice focuses on mergers and acquisitions. So I have kind of a general knowledge of business formation issues, contract issues, and I've also been volunteering with the DC Bar for about 4 years or so. Echoing what Jennifer said, you know, it's a great organization. It's a great opportunity to be able to give legal advice directly to small business owners and entrepreneurs. You know, there aren't a lot of opportunities to do pro bono work in kind of the corporate area, and so I really value the opportunity to speak to small business owners like you at these clinics.
Great, so we can dive right in with that. Okay, so as you can see, we've got a pretty full agenda for you today. So first, we're going to just walk through the different ways that you could choose to structure your business, either with or without a formal legal entity. Second, we will outline the reasons why business owners often should form a legal entity in connection with their business. Third, we'll discuss some consequences that could arise if you don't keep your business affairs separate from your personal affairs. And finally, we'll give you some practical tips on how you can make sure that your business is viewed as being fully separate from your personal affairs. One quick note before we jump in. While this presentation will touch on some tax and accounting matters, this really is primarily focused on legal implications around keeping your business separate. And so we would recommend that you talk to a tax advisor or an accountant if you happen to have questions on how tax and accounting might relate to your business generally. Everyone's tax and accounting situation is different. And so it's really important to get specific advice from those experts on your particular situation. And as Christine mentioned, excuse me, we will leave some time at the end of this presentation to answer questions. So once we've gone through the slides, please, please, please do type any questions you might have into the questions section of your webinar control panel. We would love this to be as helpful as possible for you. So diving right in, what are the various ways that you can structure your business? There are many different types of business structures and legal entities. Today, we're really going to focus on the ones that are most commonly used by small business owners, particularly those who tend to be clients of the DC Bar Pro Bono Center. When you're thinking about business structures, the threshold question is going to be, do you want to form an entirely separate legal entity for your business or not? Now, if you are the only owner of the business and you do not take any steps to form a legal entity, then by default, you are going to be what is called a sole proprietor. Again, this is by default, right? So you don't have to file any paperwork or do anything. You are automatically going to be viewed under the law as a sole proprietorship. This is the simplest form of business structure, and the practical implication is that you as an individual and the business are legally one and the same. You could certainly file to operate under a trade name or a doing business as name, but that's not going to change the fact that in the eyes of the law, you and your business are the same. Debts of the business are yours, profits of the business are yours. If you have more than one owner or partner in the business and you do not take the steps to form a separate legal entity, then by default, you are what is called a partnership. This is essentially the same thing as a sole proprietorship, but just with more than one owner. So again, the owners and the business in that situation are going to be considered one and the same. And again, this applies by default. So even if you've taken no actions, you'll be viewed as a partnership if you have multiple owners in the business. Now, on a partnership in particular, note that this means that if your business partner does something on behalf of the business, so for instance, buys a car, you could ultimately be on the hook for that if the business partner were to stop making payments or up and leave or something similar, because again, you and your partner are viewed as one and the same as that business. Now, if you do decide to form a separate legal entity for your business, the two most common options for small business owners would be a limited liability company, which is often called an LLC, or a corporation. Both of these options are going to create a separate legal entity that exists separate and apart from the owners, and they cost about the same amount of money to form. But we find that small business owners often will prefer an LLC. And the reason for that is twofold. So first, corporations often require compliance with certain formalities. So they need to issue stock. They will need to issue to appoint directors. They'll need to have director meetings certain times in a year, keep regular minutes, etc. So there's just a lot of formalities and upkeep that's associated with a corporation. Whereas LLCs will provide a lot more flexibility regarding ownership, management, and just generally operations. There's also a tax difference between LLCs and corporations. So in a corporation, the corporation itself will pay taxes on profits when it earns them. And then if it distributes those profits up to the owners of the business, the owners will also have to pay taxes on those profits when they receive them. So there's almost a double taxation going on in a corporation. Whereas with an LLC, the LLC is not going to be paying taxes on the profits when they're received. Instead, those profits will essentially flow through the company and are just reported on the owner's personal tax return. So there's not tax being paid twice in an LLC situation. Now, the main benefit to forming a legal entity, so an LLC or a corporation, is that it provides for what is called limited liability. So let's say that you have a business and that business took out a loan and stopped making payments on the loan. Or the business enters into a contract to buy books and fails to pay the seller for those books. Or the business operates a store and a customer comes in and slips and falls in the store. All of those scenarios raise the question of who would ultimately be liable for that debt or for that failure to pay or for the injury that might have resulted from the slip and fall. If you have a sole proprietorship or a partnership, which again, that's sort of the default business structure that you'll have if you have not created a separate legal entity. For those entities, because the owners are viewed in the eyes of the law as being the same as the business, the owners are ultimately going to have unlimited personal liability for any amounts that the business might own. So if for whatever reason the business has been sued and there's been a judgment for $50,000 and the business itself only has $20,000 in its bank account, the plaintiff in that lawsuit can come after you individually as the owner for that remaining $30,000. Now, contrast that with a situation in which the business owner has actually formed a separate legal entity, so an LLC or a corporation. If you've done that, that LLC or corporation is going to be viewed as separate and apart from you as an individual. So that legal entity will be liable for the debts and the claims of the business, and you yourself will not be personally liable. The amount of what you might have to pay in that situation would generally be limited to whatever you've actually invested into the business. So in that previous example, we talked about if the plaintiff has won a $50,000 lawsuit against the business, they're not going to be able to look to your personal house or your personal car to help satisfy that payment. Now, just keep in mind that the benefit of limited liability that we're talking about here, it really only applies to the owners and the shareholders of the business. It doesn't shield the business itself from liability, right? So if someone has slipped and fallen in the store, that person can certainly look to the assets of the business to try to get compensated for that. It also does not limit the liability of employees or officers or directors who are acting within the scope of their duties. There's separate protections that you can put in place to help protect officers and directors and employees, and we'll touch on that a little bit later. But the limited liability protection that you get by virtue of forming a separate legal entity, that really provides protection to the owners of the business and make sure that liability is not going to extend to those owners in their capacity as owners.
So now let's talk about what happens if you don't keep your business separate. So the biggest risk, obviously, is that if you are sued for a debt or other obligation of the business, or, for example, a lawsuit is filed against the business, the risk is that a court could find you as the owner personally liable. So in practice, if someone is going to sue a business, very often they will sue both the business plus the owners plus anyone they have ever come into contact with at the company, at the business. So someone to slip and fall at a restaurant, they might sue employees, the owner of the business, and when that happens, the courts are generally reluctant to disregard a separate legal entity like an LLC or a corporation and hold the individual owners personally liable. However, there is a mechanism in which courts can find personal liability of the owners, and they often do that when they often impose that when they find it necessary to protect innocent third parties from fraud or injustice. So what this is called is piercing the corporate veil. And so when a court is deciding whether to pierce the corporate veil, which is kind of a legal term of art for looking through or past a legal entity to impose liability on the owners, courts consider a number of factors in an inquiry that is very fact specific, and that to determine whether or not the business was operated as its own business unit, separate and distinct from the owner's personal affairs. And while it's called piercing the corporate veil, many jurisdictions have applied that same analysis to LLCs as well. And so, as I said, the courts look at a number of factors, and several of them are related directly to keeping your business separate. So a couple of examples here: failure to observe corporate formalities. As Jen mentioned, if you form a corporation, there are a number of things you'll need to do, like make proper corporate filings, issue stock, elect directors and officers, hold shareholder and director meetings at least annually, So there are a number of formalities you have to follow. This is actually one of the reasons why LLCs are often more attractive to small business owners, as they can usually be run a little more informally without these formalities. Lack of corporate records, if you don't keep good written records related to the business, this will make it look more like you weren't treating the business as a separate legal entity apart from yourself. Commingling of funds, this can include using the same bank account for both your personal and business funds, using personal funds to pay for business expenses, or using personal assets for the business without some kind of proper documentation. And then diversion of assets. So it's a little related to commingling of funds, but it includes things like using business funds for your personal expenses, using business assets for your personal use, like using a company car to run personal errands, things like that. And so we'll get into a little bit more discussion on this point, but one point I want to mention on this slide is that so far we have talked about keeping your business separate from yourself, your personal assets and things, but that's usually the main issue for most business owners. However, we want to note that this same analysis applies when you run multiple businesses. So, one of the primary benefits of operating 2 or more different businesses out of different entities is you get the protection of one business from the liabilities of the other. So let's say you operate a food truck and a consulting business. You operate 2 businesses at once. It often makes sense to operate those businesses out of separate legal entities, because the food truck business is going to be more likely to be prone to liabilities and lawsuits, et cetera, because you're driving a truck around, you're serving food to people. Those are higher risk activities where you might incur more liabilities or lawsuits than providing consulting services. So you might want to keep those businesses separate in separate legal entities for that reason. However, if you fail to keep those businesses separate from each other, and you instead do some of the things we're talking about here, like mixing funds and assets between the businesses, the court might find that the owner and one of the businesses could be responsible for liabilities of the other business. So this whole analysis applies not only to keeping your business separate from yourself, but if you operate multiple businesses out of separate legal entities, it applies to keeping those 2 businesses separate as well. So want to give you, just to make this a little more tangible in real life, give you some examples of what this kind of veil piercing analysis looks like, and what are the kinds of things that a court would consider in some scenarios that might feel more real than the kind of abstract concepts we're talking about. And these are cases, we're going to discuss just a couple cases at a high level from the DC, Maryland, Virginia areas, in which a party sued a business and sought recovery from the owner by piercing the corporate or the LLC veil. So the first case here, Brooks v. Becker, is from 2005 in Virginia. Becker Interiors was a project manager. They hired Stephen Brooks, a subcontractor, to do some work as part of a home renovation project that Becker Interiors was managing. So Becker Interiors hired Brooks, failed to pay him $55,000 that he was owed. Brooks sued Becker Interiors, which is a corporation, and won the lawsuit in court, but the corporation had no assets to pay the judgment. So Brooks went ahead and sued the owner of the business, Ronald Becker, who was the sole officer, director, and shareholder of Becker Interiors. In analyzing whether to pierce the corporate veil, the court held that Brooks could recover against Ronald Becker directly for the $55,000 he was owed, as the court found that Becker had essentially treated the corporation's funds as his personal piggy bank. Some of the examples the court gave were that Ronald Becker had used $100,000 of the business's funds to renovate his own residence. He used about $185,000 to pay his own personal credit card bills. He sold the corporation's vehicles for $74,000 and deposited the funds in his personal account. He took an income tax refund check that was payable to the corporation and instead deposited it in his own account. And he generally commingled his personal funds with the corporation's funds. And ultimately, the court found that the separate personalities of the corporation and the individual is no longer existed here, which is why they allowed this person to recover directly against the owner. So in another lawsuit, Peters v. Guy, this was in Maryland in 2018, Guy was the sole owner of Early Healthcare Giver, Inc., and that business was sued by one of its former employees for failure to pay overtime. The employee won a judgment of $18,600, and while the case was on appeal, Guy took all the money out of the corporation, ceased operations, and the employee then, essentially couldn't recover against the corporation. The employee sued Guy directly to recover that money and won. And so what the court looked at, and here obviously there's some intentional fraud going on, some shady activities with Guy kind of essentially stripping all the assets out of the corporation just so they didn't have to pay the funds. But the court looked at several factors here, one of which was that Guy essentially observed no corporate formalities whatsoever. She never held a meeting of the board. She never issued stock. She never had bylaws or any rules to govern the corporation, never made any required filings, and the corporation had no secretary, which is required for Maryland corporations. She kept no records of money she withdrew from the corporate accounts for herself and basically just took out kind of money whenever she wanted. And she used tens of thousands of dollars for personal expenses, charged personal expenses to corporate accounts. This caused the corporation to essentially fall into tax debt while Guy underreported her income and thus was assessed additional taxes by the IRS. So, the court looked at several factors that were directly tied to keeping businesses separate here in finding that the aggrieved employee could just sue directly against the employer or the owner. And so, in those two cases, the facts led the court to find that the plaintiff could recover directly against the owner for a liability or a lawsuit of a business. Now let's look at a counterexample. So in Krause versus Apex Custom Homes LLC, this was a Virginia case from 2019. The Krauses were a couple that entered into a contract with Apex, which was owned by Scott Prendergast, for construction of a single-family home. The Krauses claimed in their lawsuit that Apex had performed defective work, which Prendergast disputed, and the Krauses sued Apex for breach of contract. In their lawsuit, they sought to pierce the corporate or the LLC veil and recover directly against Prendergast. The court denied their ability to do that, so they essentially, held that the Krauses could only recover against the business and not the owner. And so the court found they were not entitled to pierce the corporate veil and recover against the owner directly. And some of the reasons that the court cited for this were that Apex had an LLC operating agreement and Prendergast had abided by its terms. Apex had maintained its own bank account separate from Prendergast's personal account, and Apex kept detailed ledgers and financial records, which the court reviewed and stated showed the ordinary, routine, and proper expenses of a small business. So this was kind of a counterexample of where the owner kind of took the right steps here. They observed the formalities, they abided by the governing documents, they kept things separate, and the court ultimately found that the owner, they could not recover directly against the owner. So far, we focused mainly on the benefit of limited liability protection when talking about why to keep your business separate. And that, I think, is probably the most important one. And so, Warren's the most focused, but we do want to mention here, there are some other reasons to keep your business separate. So for tax purposes, obviously, I'm sure many of you are aware that one of the main tax advantages of a business is the ability to take deductions for certain business expenses. Keeping accurate, separate records will make it much easier to track and claim these deductions and will reduce the risk of any issues that arise if your business is ultimately audited. If you haven't kept the records of your business expenses and accounts and things like that separate from your personal, you may not be able to take all the tax deductions you're entitled to, or if you do take deductions, you may not be able to fully support them if the IRS were to audit you. And that can cause issues not only for your business taxes, but also your personal taxes. The IRS and the tax code also make a distinction between businesses and hobbies. And the distinction is generally that a business is carried out for profit. Many people, and many of you, may be starting businesses that are related to a passion of yours or a hobby of yours, and you're kind of looking to turn it into a for-profit business rather than just a hobby. And so if the IRS were to decide that your business is actually a hobby, you wouldn't be able to take tax deductions for your business expenses, or take any losses on your tax return from the business. And so keeping separation between yourself and your business and keeping separate records makes it clear that this is a legitimate professional business and not just a hobby that you're trying to take some tax advantages for. Business credit is a very important thing for many small businesses. Many small businesses at some point, when they're first formed or if it's down the road, they'll need to apply for loans, and it's very difficult to do so and to get approved for a loan if you can't provide detailed financial information about the business's assets and income separate from your own personal assets and income. A bank will not respond very favorably to an application if you kind of can't provide them with detailed financial records, or if those records are kind of mixed together with your own personal assets and income. And finally, just kind of a general point, it's just as you conduct your business and get started, there are a lot of things to keep in mind. You may be trying to establish relationships with customers, suppliers, landlords, other counterparties, and maintaining separation between your business and your personal affairs, just kind of in a general sense, will make your business look more professional and more established. It definitely makes your business look more professional to have a separate bank account for your business rather than somebody kind of paying you to your personal account, something like that.
Great. So we've talked a lot about how important it is to keep your business separate and all of the bad things that can happen if you don't, which can be intimidating and scary. But now we're going to walk through just some simple and straightforward actions that you can take to make sure that your business is in fact separate from you as an individual. So the first step is, as we've discussed, consider whether to form a business entity. The primary reason to keep your business separate from your personal affairs is to preserve the limited liability protection that you might have. But you're only going to have that limited liability protection in the first place if you actually form a legal entity that offers it, like an LLC or a corporation. So the first step is going to be to form the legal entity, put in place governing documents that outline how the entity will make decisions or approve major expenditures, and then actually follow those procedures and keep records of any actions that the entity might approve or any board and shareholder meetings you might have. Now, as Brad just illustrated when he walked us through those court cases, just forming a legal entity itself is not going to be enough if you don't actually respect that legal entity and treat it as separate from your personal affairs. So there are a few other things that you can do to make sure that in a court's view, you are actually treating the business as separate. So first and foremost, when you form a legal entity, you should do everything related to the business in the name of that legal entity. So if you are leasing office space or signing a contract to purchase goods or buying a car or entering into employment agreements with employees or really doing anything else, all of that should be done in the name of the actual legal entity. So it should be small business LLC that is buying the car or entering into the lease, and not John Smith as an individual. Now, obviously, small business LLC is not a person, and so you're ultimately going to need a human being to be able to sign something, right? It makes it easier if in the governing documents, when you're forming the legal entity, you appoint yourself or whomever else as an officer of the company and give yourself a formal title, such as president or CEO or treasurer or whatever it may be. That way, you are formally appointed as an officer or a representative of the company, and you can take actions in your capacity as a representative of the company and not as you individually. So on this slide, we've shown how you should be signing documents to make it really clear that you're signing in your individual, not as an individual, but rather in your capacity as an officer of the business. So the left-hand side of the slide, this shows the wrong approach. Here, the individual, John Smith, has just signed the contract. There's nothing in this signature block to indicate that it's actually the entity signing, this, or that John Smith is an officer of the entity, or that the entity is otherwise involved at all. This is just John Smith having signed as an individual. The right-hand side of the slide is really what your contracts should look like. So it's the entity who is entering into the lease agreement or whatever it may be. And when you actually go to sign it, it's still the entity that is signing the contract. It's just being signed by the entity's president, John Smith. One distinction I do want to make here is just with respect to personal guarantees. So there might be a situation in which you are asked to provide a guarantee on behalf of the business in your capacity as an individual. So for instance, if the business wants to take out a loan or sign a lease, many banks or landlords may ask you to provide a personal guarantee for that loan or for those lease payments. This is especially common for a new business that doesn't have a long operating history or doesn't have a ton of assets, because the bank or landlord will just want some added protection that they're actually going to get paid back. So in that situation, that personal guarantee would of course need to be provided by you personally and not by the business. You'll need to make the decision as to whether you're willing to provide a personal guarantee, which would, by doing so, mean that the bank or the landlord can come after you personally to ask for repayment of that loan or of that lease, those lease payments if the business hasn't paid them. But we raise this because we just wanted to sort of flag that it does not, by entering into a personal guarantee, that does not necessarily undercut the separation of your business. And in fact, it might actually help you provide more evidence of separation, right? Because it makes it clear that you individually are supporting the business in a completely separate capacity than your officer position, and that the bank or the landlord who's involved here is actually viewing you and your assets as separate from those of the business. So again, personal guarantees, they might come up. They do not necessarily pierce the veil themselves, but it is going to be a personal decision that you'll want to make of whether that's something you're willing to provide in support of your business. Other things that you can do beyond signing contracts in the business's name. So we recommend opening a separate bank account for the business. If you do that, it should be in the name of the business, not in your personal name. And anyone who might need to sign documents related to that bank account should do so on behalf of the business in their capacities as officers of the business. And again, not in any personal capacity. Similarly, if you have the need for it or think that this is a good business decision, and you need a credit card or a checkbook or something like that, applying for those items in the business's name as well is just going to make it crystal clear that that entity really does have separate financials from you as an individual. You ideally would not want to be using your personal credit card for business expenses. It can just make it tricky to keep separate records and to track how you're spending things. But if you're in really early stages of the business, or if you otherwise have to use your personal credit card, you should just make sure that you are tracking those expenses really carefully. You want to have very clear records of what expenses were business expenses, what expenses were personal expenses. You want to keep separate receipts in case there's a tax audit down the line. And you generally want to make sure that that business profits are not going to be used to pay off the portion of your credit card that you used for personal expenses. One thing that can help with this is to get accounting software like QuickBooks that just provides a more streamlined and efficient system for you to be tracking your personal expenses versus your business expenses. Item 4 here, so you'll want to keep a written record of any money or assets that you or anybody else puts into the business or takes out of the business. So if you're putting money into the business, that should be documented either as a loan where you expect the business to pay you back down the line, or just as an investment where you're investing your funds into the business. But either way, that should be clearly documented, and you should keep that in the records, the books and records of the business, should you ever need to show evidence of the funds that have gone into the business. whenever you are interacting with the business as yourself individually, all of those transactions should be done on what we would call arm's length terms. And that basically just means that those transactions, whether it be a loan or whether it be a contract for you to provide services to the business, whatever it may be, you will want that to be on the same terms as if it were with an unrelated third party and not you as the owner. So if you're going to loan money to the business, for instance, you want to charge interest for that, right? Because if you were going to be loaning money to a completely unrelated third party, it's really unlikely that you would just do that out of the goodness of your heart. You'd probably be charging them an interest rate to compensate you for doing that. So you want to take that same approach here. And again, the real takeaway on this is just treat any transactions between you individually and the business as if you are truly completely unrelated separate parties. The next bullet, so all of these things that we've been talking about here, they're really only going to help if everybody who's involved in the business is on the same page and is taking the same steps. So if you have co-owners or board members or employees, or if you just have family members that are helping you with the business, all of those people, you should be sitting down with them and making sure that you've educated them on all of the points that we've talked about today, because they need to be doing them too. If your co-owners or your employees are signing things in their own personal names and not in the name of the business, or are commingling funds or aren't keeping separate records, it might not matter that you were doing things correctly. The court is going to look at their actions as well. And finally, mistakes happen, right? That is just the nature, human nature, is mistakes happen. So doing or failing to do any of the things that we've talked about today is not going to be the end of the world. Courts have explicitly stated that the fact that shareholders are sloppy in administering corporate affairs is not sufficient to warrant piercing the corporate veil. There must be some sort of unfair advantage or fraud or injustice. So all of that is to say, if you do make a mistake, just make sure that you fix it and that you do your best to put in place systems to ensure that you don't make that mistake again. So as an example, if you write a check for a business expense out of your personal account, write a check from the business to reimburse yourself for that, and make sure that you document all of that in the books and records of the company. And then going forward, keep your personal checks and your personal credit cards and your other personal financial records in a separate drawer or a separate room from where you keep your business items, just to lessen the chance that you will mix those up going forward.
So we want to point out here before we get to questions is we have talked about, we talk a lot about forming an entity with limited liability protection as being an important way to protect yourself, and that's definitely true, but it's not the only way. And so we want to just flag a couple other things to keep in mind as you go forward with your business, things that you may want to do or keep in mind to protect yourself and your business from liability. So, some of these things are obvious, some of these may not be as obvious. You should definitely consider taking out business insurance. So there are, obviously, in the insurance world and the different products they offer are complex, and would advise that you speak to a broker to get into the specifics. But at a high level, there's kind of general liability insurance, which covers the business generally for most areas of liability. And then there are more specific forms of insurance that you might want to consider that are specific to a particular type of business. So a restaurant and a consulting business might both have general liability insurance, but the consulting business, there might be insurance specific to fraud or professional liability if you're kind of an accountant doing accounting consulting. Whereas on the restaurant side, there will be specific types of insurance for restaurants and food liability and things like that. So keep that in mind. Keep in mind the business insurance option. If your business is one in which you're going to be entering into contracts, so for example, if you're a consulting business, you're going to be entering into consulting agreements with your clients. If you do home renovations, you'll be entering into agreements with clients to do those renovations. You may want to create your own form contracts that you give to your clients to sign rather than letting the other party offer up a contract. So oftentimes, when a business and a client get together and you're going to enter into an agreement, there may be a question about which side's form contract you would use. If you as the business have a form contract to offer and you have drafted that in a way that is favorable to you, that's going to be obviously a better situation for you. So we would advise kind of creating and presenting your own form contracts that are drafted in a way that are protective of you. It's also just easier from a standardization standpoint. If all of your client contracts are on one form, makes it much easier for you to manage your exposure, your risk, your liability, than if you have 100 different contracts on various different forms with different liability provisions. Whether or not you create your own form contracts, make sure you read the contracts that you sign for the business carefully, particularly the provisions around the potential liability of the business under the contract and any limits on that liability, if there are any. So often contracts will set forth what are called indemnification provisions. These provisions set out what the parties will indemnify the other party for, or kind of reimburse the other party for. And so, for example, a contract might say that your business will indemnify the client for any negligence or fraud or violations of law that the business, carries out as part of the contract. And there may also be indemnification going the other way, where the client indemnifies you. These are very standard provisions and don't necessarily, raise red flags, but the scope of those provisions and the liabilities that they cover vary significantly. So it's a very different thing to say that your business will indemnify the client for, any issues that arise under the contract, or any acts or omissions of you or your employees. That's very broad and very different than saying your business will indemnify the client for any breach of the contract or any violation of law or any gross negligence. Those are narrow and more limiting of your liability. The other aspect of those kinds of provisions are oftentimes there will be a separate provision that says the party's liability under the contract will be limited to either X dollars or the total amount spent under the contract. And so if you are drafting these form contracts, you will want to have the indemnification provision where you're obligated to reimburse the client for something. You'll obviously want that to be more narrowly tailored, and you'll want to include a provision that says the business's liability will be capped at an aggregate amount of X, or capped at the amount that the client pays you under the contract. Otherwise, there could be a scenario where a client pays you $10,000 for a home renovation, and they sue you, something goes wrong, and they sue you for $1 million because the whole house has become less valuable, or there's a much bigger issue that has arisen, and so you want to try to limit your liability through that. I'll insert a plug here for the DC Bar Small Business Clinic. This is an area where I often see clients come in to those clinics. They'll come in with a form contract that they found, or they've drafted, or they've gotten from a friend, and they'll bring it into the clinic, and an attorney, a volunteer attorney there, will walk through that with them and kind of explain and suggest some edits. So that's definitely an option, because obviously we know that retaining attorneys is expensive, but that is an option that the DC Bar Small Business Clinics offers. So here we'll open it up for questions, and before we open up to some of the questions here beforehand, I think some of the attendees submitted some questions to the DC Bar, and so we'll walk through some of those quickly, and I think they're fairly broad questions that many of you may be having. So the first question we got before the presentation was, is it okay for a non-owner, such as a manager or a CEO, to act on behalf of a business without confusing that they are separate from the business and shouldn't be personally liable. So that, yes, so it's definitely okay to be acting on behalf of a business. As Jen mentioned, the key here is just to make sure you're acting clearly in that capacity and not in your personal capacity. So if you are a president, manager, CEO, whatever your title is on behalf of the business, of course, it is okay for you to be acting on behalf of the business, but you should be doing so in that capacity. So if you're signing a contract, you should be signing as CEO of the business or whatever your title is. So just making it clear to the counterparty that you're acting in that capacity.
We also got another question. Does this topic matter for businesses that don't have profits or assets yet, or for owners who don't have assets? Short answer is yes. This is a super important topic, even for new businesses. Even if your business doesn't have profits or assets, it can still incur liabilities, right? It can still be sued. So it's really important to have those protections in place, almost arguably more so if the business doesn't have profits. And if an owner has very few assets, you still want to protect those few assets that the owner might have. And we would just note too that to the extent you're sued and you don't have the assets to pay the judgment, that doesn't mean that the judgment just goes away. That sticks with you, and it could have impacts on credit scores, future employment opportunities, a whole host of things. So the short answer is yes, at all stages of the business, even if you don't have profits yet, this is going to be a really, really important topic to make sure that you and your business are protected.
Another question was, how do owner protections for C Corps or corporations differ from protections for partnerships, LLCs, and LLPs? The protections for shareholders of corporations and owners or members of LLCs are generally the same. The liability is limited to your investment in the business. There is no, as Jen mentioned, there is no liability protection for a general partnership. We won't go into detail in this presentation. LLPs are limited liability partnerships. They're a little more complex than just general partnerships. As a high level matter, LLPs do offer the ability for certain partners to be limited partners who do have the same limited liability protections as owners of corporations and LLCs have. But the distinction is that an LLP is required to have at least one general partner who has unlimited personal liability. So we won't get into detail. LLPs are a little more specialized, but to the question about protections are generally the same between corporations and LLCs.
Great. I think the next two questions we've addressed a few times, so I'll skip over those. But the next one is, if I use personal assets like a kitchen to produce goods, is that susceptible to liability or liquidation if the entity is then sued? Yes, that is definitely a risk, and is why it's going to be important in that situation to put in place other protections to make it clear that you and your business are truly separate. So in this example specifically, one thing that you could do is enter into an agreement between you as an individual and your business for use of the kitchen, where the business either pays you, some sort of market rate to be able to use the kitchen, or otherwise compensates you for that. So again, that will show that you really are distinct and separate from the business, and that this agreement for them to use your kitchen has been done on an arm's length basis and sort of on the same terms that you would have put in place if it had been a completely unrelated third party that had asked you for use of that kitchen.
Next question was, if an agreement has been accidentally signed in a business owner's personal capacity, are there any steps the owner can take to protect themselves or assign the contract to the business entity itself? So, as Jen mentioned, it's not the end of the world. Mistakes happen. The best bet here is to amend the agreement or to enter into a new agreement where it's the business that is the party, not the business owner personally, or to have the agreement be assigned to the business. Unfortunately, unless the agreement allows the parties to assign without restriction, which would be uncommon, you would likely need the other party of the contract to agree to those steps. And if the one option, if the counterparty says, well, we want it to be with you and not with the business, we don't know much about the business, but we know you, but one option maybe to get over that hump is, as what Jen said, this is up to you, but personal guarantee. If you have if you're able to get them to amend the agreement to be with the business, but have you provide some kind of personal guarantee, that does enable some separation there, although there obviously is still some risk to you.
Okay, we've got a couple more questions. I think the next two actually go really well together, so I'll try to combine them. But the questions are, is a separate business email address important? And how should a business owner make clear that they are acting on behalf of the business when there are oral or informal agreements like those over email? So I think from an email perspective, a separate business email is a great idea. It can just, again, provide separation as much as possible to make it really clear when you are doing something on behalf of the business versus when you're doing it in your personal capacity. So if you are having some sort of informal agreement via email, even just updating your signature block in your email to say small business LLC, John Smith, president, in the email signature block can indicate that that is the capacity that you're acting in. And if that ever does turn into a more formal arrangement, again, just making sure that the contract itself refers to small business LLC. I think more generally, a separate business email is helpful because, especially if you do have your own website with your own domain, you can have the website be you can have your email address, I should say, be johnsmith@smallbusinessllc.com. And then anytime that you're communicating with somebody, that's going to be a very clear signal that you are a representative of the actual business.
Another question we got, obviously topical here, is there a problem if an owner advertises their business or promotes it on personal social media accounts as, their or my business? No, there's no issue with that. I mean, you are, in doing so, obviously advertising and promotion, that's a key aspect of starting a business. If you're presenting it as a business, as your business, particularly if you're using the business's name or the entity's name, there's no problem there. It would be if you are advertising it or promoting it, without any kind of reference to it being a business. An example, let's say you're selling, beauty products and you're promoting them on social media. If you form an LLC to do this business, but you just say, hey, I'm selling beauty products. Reach out to me on social media, and send me PayPal me money, and I'll send it to you. If you're just saying that you're the one, selling the product, if they're paying your personal PayPal account, you're not operating through the business. That's where it becomes more of an issue. So I think the same kinds of recommendations that we had in this presentation about how to make sure that you're keeping your business separate still kind of apply there. But there's no issue in and of itself of advertising and promoting the business as being yours, or the business that you're running or owning.
All right, so one question that we've received several times is, if small business owners are supposed to keep themselves separate from the business, how should they pay themselves? In the worst, most lawyerly way, the answer is it depends. There are several factors that go into how a business owner is paid, and it's going to come down to a few main factors and a lot of small factors. First of all is going to be what type of business entity has been formed, the owner's role in the day-to-day of the business, and there are also some tax options. If that is a question that you want to make sure that either you're doing it properly or convert to paying yourself properly through your business, I recommend that you sign up for the Pro Bono Center's Small Business Brief Advice Legal Clinic that I mentioned at the beginning, and Brad and Jen are both volunteers and have mentioned. You can sign up for a free consultation with an attorney online through our website, probono.center/NPSB, and I will also type that link into the chat box, probono.center/NPSB. All right. Another question that we got, is it important or necessary for a sole proprietorship to appoint a representative of the company that has the capacity to enter into agreements?
So this is a sole proprietorship. I think so. We have been talking about entities here, but there is nothing preventing a sole proprietorship from having different officers or other representatives. It can be important in certain ways in that you may want to give certain people express authority to be able to act on behalf of the company, and maybe to the exclusion of other people, or to make clear to people that you interact with, like counterparties, who is authorized to act on behalf of the company. It won't ultimately prevent you from having personal liability for actions of the business. But one way it could help in limiting what you could have liability for is, let's say that there's someone out there who is, a disgruntled employee or someone out there who's going around purporting to act on behalf of the business. If you have made clear through documented, through contracts, organization documents, other things that you have authorized XYZ people to act on behalf of the business, that makes it clearer to show later on in court or in a dispute that these are the people who have authority to act on behalf of the business and bind the business, whereas this other person over here did not. So I could see it helping in that regard. But ultimately, to the root point of the presentation, if there is a liability or a lawsuit or something that the business is found liable for as a sole proprietor, you would still be liable.
All right. So we talked kind of about the different entities and the differences between them. For a corporation or an LLC, is there a minimum or maximum number of owners? And does that impact their liability?
Yeah, great question. So the answer is no. There could be one owner in all of these situations. If there are going to be multiple owners, that just makes it even more important to have really clear documentation in the governing documents around how decisions are going to be made for the entity, whether the consent of all of the owners is needed to be able to spend a certain amount of money or take a certain type of action. Because as soon as you have multiple people involved, you just want to be very clear on exactly what formalities need to be followed before the business can take steps, so that there's no arguments or disputes down the line. So this is another place where the DC Bar Pro Bono Center clinic can be really helpful, is if you're working on those governing documents with your co-owners, being able to bring them to the DC Bar Pro Bono Center clinic, and the volunteer attorneys there can help you sort of problem solve and issue spot almost about questions that you might want to address in your governing documents to avoid any further conflicts down the line. But the short answer is no. You can have one owner, you could have 20 owners, that's all fine. Part of it though will, by virtue of being an owner, a lot of times what really that means is you have a piece of the actual profits of the company. So if you're thinking about 10 or 15 or 20 different people, you just want to sort of think about why it is that you want to make them an owner. Are you trying to give them management rights but not necessarily give them a share of the profits? Because there's different ways that you can structure it where you can have people involved in the business, whether it be serving on a board of directors or acting as a treasurer or chief financial officer or something like that, without actually making them an owner.
Great. So our hour is up. One last question, and I can take this one. Other than piercing the corporate or LLC veil, are there times when a business owner or officer can be held personally liable? Yes, there are rare circumstances. Typically, they surround taxes. especially payroll taxes, sometimes sales and use taxes. The government does not take lightly to not getting money that they feel they deserve. They will do lots of things to try and get that money. So be aware that you can do all of these protections. You know, you want to keep the business separate, but stay on top of taxes. You don't want to take that risk of having the government come after you. And with that, thank you again, Jennifer and Brad. And thanks to our listeners for joining us today. We'll be sending out a survey to all participants so you can share your thoughts on this webinar there, as well as topics that you're interested in future webinars on. And once you complete that, you'll get access to the recording of today's program. Remember, if you'd like to speak one-on-one with an attorney for free about your small business, or maybe a question that you asked today that's very specific to your circumstances, or some questions that were raised, you can sign up online at probono.center/NPSB. You can see our upcoming events and our online resource library at that site as well. Thank you again to Jennifer and Brad from Latham Watkins for taking time out of their packed schedules to share with us today. Thank you all for listening. Bye.